everyone, Dalton Grados with Grados Capital here, and today I'm going to be talking about the business model of trading. How do we make trading a legitimate business and not just gambling? How can we actually have a mathematical laid out expectation of how much we can make in a year from trading, and as long as we follow our plan, we can mathematically know that we are going to make money. And so this is going to be one of the most important videos I've ever made because, you know, I've observed from my friends and family and other people that are around me, maybe in my social circle, that don't understand trading or are not in the trading world. When you tell them, and you might have experienced this too, when you tell somebody, oh, I'm a trader, or I'm going to be a full-time trader, oftentimes you can kind of get weird looks and like, oh, okay, how is that really going to work? How are you going to pay a mortgage and support a family on that? And that's because most people's idea of trading is just what they've seen in the media, or maybe, oh, I know someone who made some money on Dogecoin. I mean, what's the realistic possibility that you can actually make a living from this? And so this is going to be the video that separates the boys from the men, from the real traders from the Wall Street bettors, and we're going to lay out the trading business model, because trading is a business, and if you're going to do this full time, you have to treat it like a business, and every business has a business plan and a business model to go by. I'm going to lay that out for you. We're going to crush the naysayers once and for all by actually mathematically calculating what we can expect as traders. So let me take you to this little document here that I made. Okay, so if you are a serious trader, then of course every trade has a plan. And a trading plan, very simply, is you know where to enter, you know where you're going to take profit, and you know where you're going to cut loss. You do not enter a single trade without knowing these three things. All right? So this is just a sample. This is not how I trade, but this is a sample trading plan that could definitely work. So say you trade with $1,000 into a trade. You're going to take profit as soon as you hit a $300 profit, but you're going to cut loss at negative $100. So even though you put $1,000 into the trade, you're only risking $100 because you're going to cut loss there. So this brings you to a risk-reward ratio of 1 to 3. Okay, you're risking 1 to make 3. Now with this plan, you only need to win 33%, or 1 out of every 3 trades, to break even. Okay, so you're not making money, you're not losing money, but if you just win 1 out of 3 trades, you will break even. So anything more than that will guarantee a positive expectancy. So if you can consistently get over a 33% win rate with this type of trading plan, then you can mathematically expect to make money. All right. Now the issue here is, how can you know if your win rate will be over 33%? It will depend a lot on your own skill, your technical analysis, and the ability to pick the right trades. Which is fine. Many traders do this successfully, and it is certainly within reach. And the win rate in this case scenario is going to be based more on your personal skill, because most likely you're going to be buying shares or options and trading those to try to get a 1 to 3 risk-reward ratio. But this is a perfectly good trading plan, and if you're a good trader, you can make this work. Because again, even though these trades, these low risk to reward trades are going to be lower probability of success, but you only need to win 1 out of 3 to break even. So if you keep it above that, but again, there's not much certainty other than your personal skill and ability to pick the right trades. So now I'm going to get into my trading plan and why this is a great business model for me. Okay, so I sell out of the money options and credit spreads, and so how options work is I sell around the 10 delta. Now the delta is an options term that can tell us the statistical probability of that option ending up in the money. So with the 10 delta, that's a 10% probability that will end up in the money. So there's a 90% statistical probability of success with when I sell a 10 delta option, because there's basically a 90% probability that that option will expire worthless and I will keep all of my premium. And those deltas are based on a number of factors, a bunch of complicated math that includes the strike price, implied volatility, and expiration date, among other things. But long-term back testing will show that delta and probabilities play out over the long term. So you can go and you can look up in the past, if you were to run a back test over the past 10, 20, 30 years, the deltas will play out over the long term. So, we know that a 10 delta will have a 90% probability of being out of the money, and you can go and back test that for decades and it will play out. So that is very accurate. Now, I use a stop loss, of course. I'm not going to let that trade go in the money. I'm going to cut my losses before that happens. So using that stop loss brings the statistical win rate down to about 80%. Okay? So now this is just based on the mechanics. If I sell the 10 delta, I use a 2x stop loss over the long term through tons of back testing and probabilities and statistics, that win rate will be about 80% with the stop loss. So this brings my risk-reward ratio to a 2-to-1. So I'm risking 2 to make 1. So for example, if I have $5,000 collateral for a trade, I'll take profit at plus $200. I'll cut loss at negative $400. So that's just an example. The reason why I have an inverse risk-reward is because these are high probability trades. So mechanically, they have a higher win rate percentage and less emphasis on personal ability and timing. So anytime you have an inverse risk-reward like this, like I have, it's because that just comes with the territory of selling options, because they are already statistically, the odds are in your favor. So that's why there's the inverse risk-reward. But with the 2-to-1 risk-reward ratio, I need a 66% win rate to break even, right? So if I win one trade, or if I win 2 trades and lose 1, I break even, right? Because I had a 2x loss. So 66% win rate to break even. Now I already know, based on the deltas and probabilities with the stop loss, that I have an 80% statistical probability of success going into the trade, and I know that over the long term that these probabilities do play out. So right from the get-go, when I enter a trade, I already can expect an 80% probability of success with sticking to my stop loss. Now, my trading skills and ability with technical analysis have shown that I have an actualized win rate of about 85%, and that's according to my trading log. So every serious trader, you should be keeping a log of all of your trades, just like any good business owner would keep books and keep accounting. You must keep accounting of your trading. And so according to my trading log, I have an actualized win rate of about 85%. Sometimes I'll go several weeks without losing a single trade. But then over the longer periods of time, it works out to be about 85%. Okay, so this is where you get to positive expectancy. And this is really what makes trading a business rather than gambling or having high hopes or anything like that, is having a plan that generates positive expectancy. So when I break down the math, I know that over 100 trades, and just for numbers' sake, we're going to say that there's $1,000 profit in each trade. So my max profit for each trade is $1,000. Over 100 trades, that's $100,000. I'll win with a win rate of 85%, $85,000. I'll lose 15 of those trades on a 2x stop, right? So I lost 15 trades out of 100, but I lost 2 to 1. So it's minus $30,000. So then you have $85,000 minus $30,000, $55,000 total profit for every 100 trades. Or another way to say that is a 55% premium capture rate. That's positive expectancy, okay? I know that over 100 trades, I have a 55% premium capture rate, and some weeks it might be more or less, some months it might be more or less, but over the long term, I can reasonably expect this. And so my yearly expectancy, I do this particular trade 3 days a week. I don't subject myself to any overnight surprises. So when I'm in the trade, I'm in control of the trade. I will always cut at my 2x stop loss, and there's no potential, I'm not holding any trades overnight to where there'd be a potential for a big gap down. So I do this trade 3 times a week. That's 156 trades a year. So with a win rate of 85%, that's 132 wins, 24 losses. 132 grand minus 48 grand is $84,000 a year. And that's with $1,000 each trade. And the great thing about this is, guys, and one of the reasons why I think that trading is the best business is because once you have this positive expectancy and you're able to prove it in actual results, then it's infinitely scalable. Okay, this example I used was just $1,000 profit potential per trade. Okay, but you can scale that further and further the more money you have in your account. And there's really no limits to how far you can go. So that's what I love about this business model. You get the business model, crunch the numbers. Once you have positive expectancy, then it's just all scale. The only thing in the way of you and achieving as much wealth as you could possibly desire is just scale. It's just numbers. It's just adding zeros to the balance sheet. And that is why trading, in my opinion, is the best business model. So hopefully I did a good job here of breaking down a trading business model that you can follow or emulate. And by doing this, you'll be able to break the numbers down and reasonably expect positive results from your trading. And so really it's just as simple as that. If you like this video, if you like this breakdown, give me a big thumbs up below, comment, and let me know what you think, and of course subscribe to the Greatos Capital channel. This is Dalton Greatos with Greatos Capital. I'll see you guys next time.